Beyond the headlines of trade wars lies a deeper shift. I'm Adam, and today we analyze the structural fracture of the petrodollar, a system that built the American century but may no longer sustain it. For more than half a century, the global economy has revolved around a single, silent agreement. Oil would be priced in US dollars, and in return, the dollar would sit at the center of global trade. This system, known as the petrodollar, did not merely facilitate commerce. It shaped power, capital flows, and the architecture of modern finance. Its stability allowed the United States to finance deficits, project influence, and absorb global shocks with remarkable resilience. But history rarely ends with a collapse that announces itself. More often, it begins with subtle fractures, small shifts in behavior, quiet renegotiations, and the slow erosion of trust. Today, beneath the surface of currency markets and energy contracts, those fractures are forming. Nations are settling trades outside the dollar. Central banks are rethinking reserves. Gold prices whisper what official statements will not. This is not yet a crisis. It is something more unsettling, a transition whose destination is uncertain. To understand where global trade may be heading next, we must first understand how the petrodollar came to define an era, and why that era may now be drawing to a close. Long before systems break, they begin to strain. In the global monetary order, those strains often appear first in indicators that few outside financial circles watch closely. The Fed funds rate, once held near zero to sustain growth, has moved sharply upward, reflecting the most aggressive tightening cycle in decades. At the same time, the DXY, the dollar index, has surged and retreated in violent swings, signaling stress rather than strength. U.S. Treasuries, traditionally the world's safest asset, have shown unusual volatility, with yields rising even as demand weakens at key auctions. This is a quiet but significant signal. Confidence is no longer unconditional. Meanwhile, gold prices have climbed steadily, not as a speculative frenzy, but as a deliberate hedge by central banks seeking insulation from currency risk. These are not isolated data points. Together, they form a pattern of caution. A system built on trust begins to change when its participants start preparing for alternatives. The petrodollar's dominance has not vanished, but the warning lights are now unmistakably on. To grasp why the petrodollar matters, we must understand its mechanical role in global liquidity. When oil is priced in dollars, every importing nation must first acquire dollars to secure energy. This creates a constant structural demand for the U.S. currency, reinforcing its status as the world's primary reserve. That demand feeds directly into U.S. treasuries, funding deficits while exporting inflation outward. But when inflation accelerates, as measured by the Consumer Price Index, this balance shifts. To contain rising prices, the Federal Reserve raises the Fed funds rate. Higher rates strengthen the dollar in the short term, but they also tighten systemic liquidity. Dollar-denominated debt becomes more expensive to service, especially for countries with limited reserves. This is the shock mechanism. What begins as a domestic policy response ripples outward through exchange rates, capital flows, and trade balances. When fewer dollars circulate freely, global trade slows, financial stress rises, and the very structure that once stabilized the system becomes a source of fragility. History offers sobering examples of what happens when monetary anchors weaken. In 2008, the collapse of Lehman Brothers revealed how interconnected the global financial system had become. A crisis rooted in U.S. housing rapidly spread across borders, freezing credit markets and exposing the dangers of over-reliance on a single source of liquidity. Central banks were forced to inject unprecedented amounts of capital simply to prevent systemic collapse. Other cases are even more severe. In economies that experienced hyperinflation, from Latin America in the late 20th century to more recent failed states, the loss of confidence in currency preceded economic breakdown. People fled to hard assets, foreign currencies, or barter systems. Trade did not stop overnight. It eroded gradually, then suddenly. These comparisons are not predictions, but warnings. They show that when trust in monetary systems fades, the consequences extend far beyond exchange rates. The global order shifts, often faster than policymakers expect. While the petrodollar has long insulated the United States from the constraints faced by other nations, that insulation is not absolute. As global demand for dollars shows signs of diversification, the internal pressures on the U.S. economy become more visible. Rising yields on U.S. Treasuries increase the cost of financing government debt, tightening fiscal space at a time when deficits remain historically large. At the household level, higher interest rates transmit directly into mortgages, credit cards, and business loans. Consumption slows, investment hesitates, and financial markets become more sensitive to policy signals. The Fed funds rate, once a tool for fine-tuning growth, now carries heavier consequences with each adjustment. Systemic liquidity, abundant during years of quantitative easing, has begun to contract. Banks grow cautious, credit conditions tighten, and risk tolerance declines. This does not mark the end of the dollar's dominance, but it does signal a shift. The costs of maintaining that dominance are increasingly borne at home, not just abroad. Faced with these pressures, policymakers have limited but powerful tools. The U.S. government, aware of the strategic importance of the dollar, continues to reinforce financial alliances and safeguard the Treasury market through regulation and diplomacy. Fiscal policy remains expansive, aimed at sustaining growth even as borrowing costs rise. This balancing act, supporting the economy while managing debt, has become increasingly delicate. The Federal Reserve, meanwhile, stands at the center of the adjustment. By calibrating the Fed funds rate, it attempts to control inflation without triggering financial instability. Liquidity facilities, once considered emergency measures, are now part of the standard toolkit, designed to backstop banks and prevent disorderly market behavior. These responses signal resolve but also constraint. The era of unlimited accommodation has ended. In a world where the petrodollar's dominance is no longer unquestioned, policy decisions carry global consequences and far less margin for error than before. When global systems adjust, individuals often feel the impact long before stability returns. History shows that periods of monetary transition reward preparation over prediction. The first principle is awareness, understanding how interest rates, inflation, and currency strength affect everyday finances. Rising CPI erodes purchasing power, while higher rates increase the cost of debt. Reducing exposure to variable rate liabilities becomes a form of resilience. Diversification is the second strategy. Just as central banks rebalance reserves, households can avoid overconcentration in a single asset or currency. This does not imply abandoning traditional systems, but complementing them. Through a mix of savings instruments, real assets, and skills that retain value across cycles. Gold's enduring role as a store of value is not accidental. It reflects centuries of trust beyond policy regimes. Finally, adaptability matters more than certainty. In an era where systemic liquidity expands and contracts rapidly, financial flexibility, liquidity, low leverage, and informed decision-making becomes the individual's most reliable safeguard against structural change. The end of an era rarely arrives with a single event. More often, it unfolds through overlapping transitions, each subtle on its own, yet profound in combination. The petrodollar system is not collapsing in flames. It is gradually being supplemented, questioned, and rebalanced. Global trade is experimenting with new settlement mechanisms, regional agreements, and alternative stores of value, all while the dollar remains deeply embedded in the system it helped create. This moment is best understood not as a verdict on the past, but as an inflection point for the future. Economic power is becoming more distributed, and monetary trust more conditional. The lessons of 2008, of inflationary breakdowns, and of repeated bank runs remind us that no system is permanent, only adaptive. As this transition continues, the most important signal may not be found in charts or indicators, but in behavior. How nations choose to trade, save, and insure against uncertainty will define the next chapter of global finance. The question is no longer whether change is coming, but how prepared the world is to navigate it. Looking forward, the global system appears to be moving not toward a single replacement, but toward fragmentation. Instead of one dominant settlement currency, trade increasingly relies on regional arrangements, bilateral agreements, and diversified reserves. Energy contracts denominated in alternative currencies, gold-linked settlements, and cross-border payment systems are no longer theoretical experiments. They are operational realities. This does not eliminate the dollar's role, but it dilutes its exclusivity. For markets, this transition introduces friction. Exchange rate volatility increases. Hedging costs rise. Liquidity becomes more episodic, shifting quickly between regions as policy signals change. The DXY may still surge during crises, but its long-term trajectory now reflects competition rather than monopoly. U.S. Treasuries remain central, yet they must coexist with growing demand for non-dollar assets. The post-petrodollar world, if it arrives fully, will not be simpler. It will be more complex, more negotiated, and more political. Global trade will continue, but under rules that are still being written, one transaction at a time. Every global system carries within it the conditions of its own transformation. The petrodollar was never merely about oil or currency. It was a framework of trust that aligned energy, finance, and power for an extraordinary period of stability. That framework is now evolving, shaped by inflationary pressures, shifting alliances, and the limits of systemic liquidity. What once felt permanent now feels conditional. For the United States, this moment represents neither collapse nor triumph, but adjustment. The tools of policy, interest rates, treasury markets, and central bank credibility remain formidable, yet their influence is no longer absolute. For the rest of the world, the transition offers both risk and agency, the risk of volatility, and the agency to redefine participation in global trade. History will not mark this period with a single date. It will remember it as a gradual turning point, when the world began to move beyond a dollar-centered order toward something more plural, more fragile, and more contested. In that uncertainty lies the defining challenge of the next economic era and the responsibility to navigate it wisely.